Hello, everyone, and welcome back to the Investment Diary. Today, we're going to talk about why the stock market looks overextended right now, how September seasonality might play a role, and how investors, including myself, are positioning for the weeks ahead. Before we start, if you're getting value from this video, please subscribe to the channel. We just passed 70 subscribers, so a huge thank you to everyone who's followed the Investment Diary. Let's dive right in. Let's start with current market conditions. The stock market is once again trading near all-time highs. On the surface, that looks like a sign of strength, but when we dig deeper, the story gets more complicated. Valuations are now at historic extremes. By many measures, the market is over 100% above fair value. In fact, on average, stocks are about 144% overvalued compared to long-term norms. The cyclically adjusted price-to-earnings ratio, or CAPE ratio, is also near its highest level since the 2021 bubble peak. That suggests prices have been pulled far ahead of fundamentals. At the same time, the rally is increasingly narrow. A handful of mega-cap technology names are doing the heavy lifting, while the broader market looks weaker. Liquidity and breadth are both fading. These are classic warning signs. Next, we look at signs of overextension. Let's break down some specifics. First, valuation excess. More than 20% of stocks now trade above 10 times enterprise value to sales. That's an extraordinary multiple, even for high-growth companies. Second, speculative activity is rising. Margin debt is climbing again. Call option volumes are surging. These behaviors often appear at late stages of a rally. Third, market breadth is weakening. Right now, only 65% of S&P 500 stocks are above their 200-day moving average. At prior highs, that number was closer to 74%. Fewer stocks are participating in the rally, and that makes the market more fragile. Finally, the trading structure itself looks thin. Volumes are falling, liquidity is weaker, and small shocks could create outsized moves. So what about investors? Retail traders remain very active. They're driving much of the speculative options activity we're seeing. That means a lot of hot money is chasing short-term gains. Systematic buyers, such as quantitative funds, have largely completed their buying programs. That leaves fewer automatic inflows to support the market. Professional investors are increasingly cautious. Many are trimming exposure or rotating into defensive names. At the same time, value pockets are disappearing. Outside of technology and a handful of niche sectors, it's hard to find attractive entry points. This brings us to September seasonality. Historically, September is the weakest month of the year for U.S. stocks. On average, the S&P 500 loses about 1.2% during this month. Why does this happen? There are several reasons. 1. Portfolio managers often rebalance after the summer rally. 2. Mutual funds and institutions raise cash, either for tax reasons or to prepare for year-end flows. 3. Investor psychology plays a role. September has a reputation for being difficult, and that reputation can be self-fulfilling. When you combine this seasonal weakness with today's overextended valuations, you get a setup that's especially vulnerable. Now let's focus on this year specifically. The Federal Reserve is meeting in September, and most investors expect a rate cut. That sounds bullish at first glance, but there's a catch. If the Fed delivers a hawkish message or signals less easing than expected, markets could wobble. At the same time, breadth is already deteriorating, momentum is fading, and September historically leans negative. Some strategists are forecasting a 7 to 15% correction by mid-October. That doesn't mean a crash is guaranteed, but it does mean risk is skewed to the downside. Here are the main risks I'm watching. Number 1, valuation risk. Across almost every metric, stocks are stretched far above historical averages. Number 2, narrow leadership. If mega-cap tech stumbles, the entire index could come under pressure. Number 3, weak liquidity. With thinner volumes, even modest selling can trigger sharp declines. Number 4, retail speculation. If retail money begins to pull back, that could amplify volatility. Now, let me share what I've been doing in my own portfolio. Over the past 2 weeks, I sold positions in C Limited, ticker SEA, and Palo Alto Networks, ticker PANW. Both have had strong runs, but they're also higher beta, growth-oriented names. I decided to lock in gains and raise some cash. I've been rotating that capital into more defensive healthcare names, specifically Novo Nordisk, ticker NVO, which is benefiting from the long-term GLP-1 obesity drug megatrend, and UnitedHealth, ticker UNH, a defensive healthcare leader with strong cash flows. This shift gives me more resilience and less exposure to speculative tech as we head into a seasonally volatile period. So what should investors consider more broadly? 1. Rotate into defensive sectors. Healthcare and consumer staples tend to hold up better during market pullbacks. 2. Increased cash buffers or add high-grade bonds. That provides both safety and optionality. 3. Use risk controls. Stop-loss orders or trailing stops can help manage drawdowns. And 4. Consider hedges such as protective puts or inverse ETFs if you want downside insurance. But it's not all about defense. Pullbacks can also create opportunity. Investors who keep some cash available may be able to rebalance into quality names if price is correct. The key is to focus on companies with durable cash flows, strong balance sheets, and leadership positions in their industries. It's also smart to build a watch list now so you know what you want to buy if the market gives to a discount. Finally, stay agile. The Fed's September meeting could shift sentiment quickly in either direction. We hope you found this analysis helpful. If you did, please remember to like this video, subscribe to the Investment Diary for more in-depth investment analysis, and leave your thoughts and questions in the comments section below. We always love hearing from you. Thanks for tuning in, and we'll see you in the next video.